Welcome to our webinar on the right way to analyze investment property. My name is Scott Pastel. I'm the VP of Marketing at Marshall Reddick Real Estate, and very excited to provide you with this information. As you'll see, Marshall Reddick Real Estate, our business actually started in 1979, and we've had just decades and decades of experience selling properties in California and in other places across the country. And one of the main questions that we get from our clients is, what type of due diligence should I be doing? What should I be looking out for? What types of information and resources are reliable? What resources and websites aren't reliable? So it's a question we get all the time, and just very happy to be providing you with this information, and I hope that it's very helpful. In the next hour, I'll be going through a little bit of information on who we are, our background, and then of course different websites and resources to use, different calculations. So let's jump right into it. So for those of you that aren't very familiar with Marshall Reddick Real Estate, we are a licensed residential real estate broker. Our office is located in Newport Beach, California, and we make it possible to purchase residential real estate in carefully selected markets across the United States. We're also a licensed mortgage lender, and we originate private money loans for buy and hold investors. So we have 15 and 30-year fixed interest rate loans for those that can't qualify conventionally. We are also a licensed property manager, so we do property management in-house in Orange County and Los Angeles. And then we have affiliate property managers in many different markets of the country. So you'll see down below any resources you're looking for, whether it's lenders, CPAs, insurance agents, attorneys. We have the team in place, and I always say who you work with is more important than where and what you buy. So we're here to talk about the right way to analyze investment property, and the reason that I have the word right italicized and underlined is because I am constantly watching clients or beginning investors really not having any direction or understanding of where to get their information from, really not having understanding or direction on what types of information is reliable, and really just going all over the internet, just kind of getting completely lost in the information, and then looking at things that aren't relevant or current or accurate, missing things that are important. So when it comes to analyzing investment property, there's certainly the right ways to do it and wrong ways to do it. So I really hope this presentation uncovers a lot of the misinformation or misnomers that maybe you've encountered in the past. So we all kind of look like this in the beginning, right? When we're new to real estate, where we've got this look on our face and we've got really no idea what we should be looking for. We might be receiving properties or looking at them on our website or on Zillow or Trulia, and then asking ourselves, well, so how do we do our own proper due diligence? So this is what we're going to cover. First, we're going to start off with the first and most important step is, what is your investment criteria? Do you know what your investment criteria is? Do you know why you have that investment criteria? Not just to follow what the media says or follow what a friend or coworker has done in the past. What is your personal criteria? And part of that is to discuss property classes, to understand the difference between A, B, and C class properties, and then figure out which property classes are going to make the most sense for your goals, for your risk tolerance, for your experience, and why. And then part of that is to understand how to use maintenance and vacancy. This is such an important part of the analytics involved in investment property, is to figure out what's going to be my true cash flow. Now, what am I going to be making on a monthly basis, which is very different than what my long-term cash flow. So I'm going to explain maintenance and vacancy and how to figure out how much maintenance and vacancy you're going to have, and break down some of the common misconceptions there, and then where to get market data. So what resources should we be using to get reliable, accurate, current market data on whatever area we're looking at. We're going to evaluate 3 different investment properties online. I'm going to share with you 3 different websites that I'm sure you've used before, and I'm going to pick out certain information that is reliable and some information that really is completely irrelevant and oftentimes inaccurate. And then finally, we're going to go over the financials, and we're going to go through the calculations for return on investment, cash on cash return, Again, I'm really going to focus on the cash flow because that's where I find most investors are completely misunderstand the definition of what cash flow really means. So let's jump right into it. We're going to start off with your investment criteria. So just like you would go through an investor questionnaire if you were working with a financial advisor, and when you do talk to a financial advisor, they're going to ask you these same questions. They're not going to be able to tell you which investments make the most sense for you until they figure out what retirement goals you have, when you're looking to retire, how much capital you currently have to invest, how much risk tolerance you have. They're going to try to figure out, is it going to be the tax benefits or the income or the capital appreciation? What's going to be the most beneficial for you? So you got to ask yourself these same questions. It helps to talk to a real estate advisor so they can evaluate your financial situation and then help you figure out which property classes make the most sense for you. But at the bottom of the screen, we're looking at a scale, and you can see that when we're further to the left, we're going to have higher priced properties, further to the right, lower priced, further to the left, more appreciation, and further to the right, more cash flow. So then you got to ask yourself, why do different property classes have different benefits? And what we'll see on the next slide is where these properties are located, and you'll find that A-class properties are going to be located in neighborhoods that have a higher percentage of homeowners. You're going to see that they have higher school district ratings and typically lower crime rate. When we get further to the right into, let's say, the C-class category, we're going to find that we have more properties in tenant-occupied neighborhoods, lower property values, maybe lower school district ratings, and really not as high of demand for people to purchase property. Right away off the bat, I would completely take out luxury class and D class. With luxury class, prices are too high, impossible to find any cash flow there unless you put down a significant down payment. And when you're too far to the right in the D class category, you're going to get the worst parts of town. You're going to get the high crime areas, the lowest school district ratings, and really places where it's going to be very difficult to have tenants that have a stable job, stable income. That's where you're going to be in the risk of having more evictions. So my recommendation, stay away from those two and stick with either A, B, or C. So on this infograph that we're looking at right now, it gives us a little bit more insight on the types of people that rent certain property classes. And we can see at the top that in luxury class or A class, we typically have college graduates. We have white-collar professionals, usually people who specialize in a certain type of job. People who have careers. There's a little bit more job stability in that category. And you're also going to find neighborhoods that have a higher percentage of homeowners. We get down to B and C class, usually high school graduates, blue-collar, hourly wage employees. Very little chance that they've owned property in the past. We get down to D class, and we're going to be in Section 8 housing, below the poverty line, low income. So we go down a little further, and it says things that matter. So what actually goes into impacting a property class? So we're going to find that it doesn't really relate so much to the age of the property, the size of the property, or the condition of the property. Like I said earlier, it's the location, school district ratings, crime rates. And to help you remember what you're going to have as a result from each property class, just remember A for appreciation, B for B class, B for both, and C for cash flow. So that's a really easy way to remember what the benefit is in each property class. Now, if you haven't read our ebook called the Redick Property Rating, it's available on our website. I'll show you where to get it at the end of the presentation. But in the ebook is this exact page. I just screen captured it and put it in my PowerPoint here. It has a link to the map we're looking at. When you click on the map, it'll take you to a Google Map page that has an interface where they've pulled data from the National Association of Realtors, and every major metropolitan market in the country, also known as an MSA, has a little house on it. We can click that house, and we can get the current quarterly median home price in that particular market. Now that's very, very helpful information, and that's going to be the essential component that we need in order to determine the property class within a given metropolitan market. Once we know the median home price in a metropolitan market, we can now take the home that we're looking at and plug it into the scale that you see in front of you right now. Now, we're sitting here right now, or I'm sitting here right now in Orange County, California, and the current quarterly home price median in Orange County as of today, which is March 2016, is a little bit above $700,000. So now I know that if I'm looking at a home in Dallas, Texas, where the median home price is about $200,000, then obviously I need to know that information so that I don't mistake a $300,000 property in Dallas for a C-class property. A $300,000 home in Dallas would be a luxury home, whereas a $300,000 home in Orange County would be well into the D-class category. So very important to know what the median home price is in the metropolitan market that we're looking at, and then that'll give us a better idea of what the property class is. So you see these percentages in front of you. The top graph is for single-family residence. The one below it is per unit basis for multi-units. So we have to adjust it a little bit if we're looking at a duplex or a fourplex. And then the border between the A class and the B class, it says 100%. That's 100% of the median home price. So we'll take an example, let's say Dallas, Texas. We're looking at a home for about $100,000. We now know that that's half of the median home price, so we're going to be well into the C and maybe even D class category. So this will give you a much better idea of the classification of the property that you're looking at. Now, why do we even need that information? Well, A, it's going to tell us the types of tenants living in the property, and B, it's going to tell us how much maintenance and vacancy we can expect in that property over the long term. So again, the one at the top is residential, the one at the bottom is for commercial property. These are percentages of the monthly rent, and these are purely estimates. And you got to realize that this really is only going to be accurate over a long period of time. If you own a property and you just look at 1 year, you may have gotten very lucky. You may have had that property rented the entire year, and you might have had little to no maintenance. Well, good for you. That's a lucky year, because guess what? In year 2 or 3 or 4 or 5, you might experience a 60-day vacancy, and you might have to fix that property up during that turnover period. You might have to spend $1,000, $2,000, maybe $3,000 on new carpet, maybe new paint. So this really is only going to be an accurate representation over about a 10 to 15-year period or longer. And these expenses are not taken out every month. You're never going to have to pay into a maintenance fund. You're never going to have a vacancy expense. A vacancy is not an expense. A vacancy is a loss of income. So hopefully that clears up, how maintenance and vacancy works. And you have to realize that the A, B, and C class properties are going to show different amounts of maintenance and vacancy over time, and for the reasons that I explained earlier in that infographic. Different parts of town, different types of tenants. So let me show you an example on vacancy. Really, really easy way to remember vacancy. If you take that percentage, multiply it by 365, it'll give you the amount of days in a year that you're factoring for vacancy. So now we know 8% is about 1 month. 10% is going to be 36.5 days. 13% is going to be about 42 days. So let's stay with 8% for a minute. Now realize that if you're using a percentage lower than 8%, then you're now giving yourself less than 30 days a year to re-rent that property if you have the tenant move out. So let's take 4%. 4% would be 2 weeks, right? So if you're looking at a property and whatever source is selling you that property or advertising that property and using a vacancy rate of, let's say, 4%, they're now saying that that entire process from move out to move in is going to take 2 weeks. Well, think about it for a second. Think about the process that has to take place from somebody moving out to a new person moving in. When a tenant moves out, the property manager is going to do a move-out inspection. They're going to walk through the property, and they're going to assess whatever damages have occurred to negligence, and they're going to figure out whatever wear and tear occurred. That's going to be the cost of the owner. They're going to take pictures, and they're going to send that inspection to the owner. The owner looks at it and now has to either get bids on whatever needs to be fixed up, or the property manager will provide them bids from their preferred subcontractors. So the owner looks at the work that needs to be done, probably asks some questions to the property manager. The property manager answers questions back. The owner finally, decides on the work that they want to get done and which contractor they want to use. Then a few days later, maybe even a week later, the contractors go out and they do the work. Property manager comes in, takes pictures, sends the pictures to the owner. The owner looks at it and goes, okay, great, everything looks good, might even have some more questions. Meanwhile, the property manager is advertising the property for rent, taking calls, answering questions, getting applicants, showing the property, choosing an applicant, running a background check, and then finally doing the move-in. So for that process to occur in less than 2 weeks is near impossible. I've seen it happen maybe 1% of the time, but very, very, very unlikely to occur in less than 30 days. And again, you might get lucky and have the same tenant for 2 or 3 years. And that's just all money in your pocket. But we're trying to be conservative when it comes to our estimates of cash flow. Let's get into researching markets. So let's say you live in California and you're researching Texas, or you're researching a market in Florida and you're not very familiar with that market. Well, a great place to start is the Bureau of Labor Statistics. So bls.gov/EAG, and that stands for Economy at a Glance. I'm not going to show you these websites because I want to spend more time actually researching properties and going through websites like Zillow and Trulia. But when you do go to that website, you'll be able to see the percentage of jobs in different industries. It'll give you the current unemployment rate. It'll actually give you the month-to-month unemployment rate history over the last 10 years. Very, very helpful so that you can understand the types of people that might end up renting your property. And then for housing affordability, a great website is the NAR, National Association of Realtors. And that's realtor.org/research/research again, and then /housing-INX. So you can jump on there and it'll give you the affordability rate in any market in the country, and that's really helpful because you'll be able to figure out how much real estate you can buy there in that market, and then are you buying property above the national average or below the national average. So kind of gives you some good insight there. And then demographics you can get from City Data. City/Data is a great website. It'll give you a lot of information about the median income levels, percentage of college-educated residents, percentage of single versus married, male versus female. It just, I don't know. I don't really put a lot of weight into that stuff, but in case you wanted to know more about the demographics of a particular market, that's a good website to use. You should always be looking at the Google Map image of any property you're looking at. Also, the street view is very helpful. So I always, no matter what property I'm analyzing, the first thing I do is I throw it into Google. I look at the street view of the on the Google Maps, and then I kind of look at the neighborhood. I look for what types of cars are in the driveways, what types of cars are parked outside. How is the upkeep of these properties? Is there trash on the lawn? What's near the property? I like to look at an aerial image to find out what schools are close by. Any nearby shopping, and then for some of us, we might want to make sure that we're not near like a landfill or a cemetery or a prison. So good to kind of get an understanding of what's in that particular area. How close is it to the downtown? How close is it to the nearest, commerce? And good questions to ask yourself too. How close are you to the nearest job market? Now, school district ratings, you're going to find that on Zillow, Trulia. You're going to find it on our website. We get the data from greatschools.org, same website that Zillow and Trulia use. So for some people, this isn't really relevant. For some people, they want to be in higher rated schools. Keep in mind that if you're looking for 8, 9, and 10 rated schools, that you're in a very high demand market. You're going to see property prices increasing faster than B and C class property. And it's going to be very difficult to get very much cash flow in an area that has the highest rated school districts, right? So you have to have realistic criteria and understand what is it that you're looking for. If you're looking for high cash flow, and if you're in an area where there's high rental demand, then the school district ratings might not really matter that much. You also have to ask yourself, do most people enroll their kids in public schools or private schools in this area? And I can tell you a great example is the Dallas area, where a lot of people in the higher income level enroll their children in the private schools. So, keep in mind you can read forums and articles on greatschools.org, but This may or may not be very relevant depending on what it is you're looking for. Momentarily, I'm going to go through a few property examples, and we're going to look at Trulia, we're going to look at Zillow, and Realtor.com. So these are good websites, but you have to really cross-reference at least 3 of them on the same property. If you're only looking at one of them, you might end up finding different or conflicting information on another. So it's important to really kind of look at each one, because each one kind of has something a little bit different. Now, when we're verifying rents, believe it or not, Craigslist is still one of the highest, most popular ways that renters find property. So in addition to being able to find property for rent on Zillow and Trulia, you can also find properties for rent on Craigslist, Realtor.com, and HotPads. I know from my experience of owning several properties and talking to my property managers that HotPads is actually the way that we've found several of my tenants in the past. So you can run comps on these websites yourself. You have to keep in mind one more thing, though, that not every property for rent will appear on these websites. Same thing with home sales. Not every property and not every listing will appear on Zillow and Trulia and Craigslist, Zillow, Trulia, and Realtor.com. So let's get into the financials for a little bit. So I'm going to start with a C-class property. So I picked this property out off our website. This is a recent property that was just put on our website by our Memphis, Tennessee team. This is a $84,900 property. It was recently rehabbed, so it's in rent-ready condition. It's vacant. We can see that it's on a huge lot, almost half an acre, and 3-bed, 2-bath. So we're getting some information. Now we want to look on the right side of the screen, and we want to look at, okay, so where do the taxes come from? Where did the insurance come from? Where did the management fee come from? You can see a little further down that the maintenance and vacancy, that came directly from the information I shared with you earlier. And I don't think I mentioned where we got that. So our maintenance and vacancy estimates came from our own data of analyzing properties that we've sold in the past over the last 5 years or so in over a dozen different markets. So we looked at the history of properties with our property managers in each market and determined that if we want to be as conservative as possible, these are the numbers we're going to use. You might have a little bit less, but we felt this was going to be as conservative as possible. So I want to point out a few different things here. So we're looking at these expenses, and right under it we see this monthly income. We see monthly income of, sorry, excuse me for 1 second, I'm having a little glitch here. Oh. Okay, so excuse all the yellow dots on the screen, but we're looking at this monthly income right here of $421 a month. So that is what some people might consider their cash flow. That's what they're making on a regular monthly basis. Now, over a 10 or 15-year period, you're going to have some maintenance and vacancy. And this is what we predict it will look like over a long period of time. So there's never going to be a month where you actually make $133. That's the long-term average. These are not coming out of your pocket. They're going directly into your pocket every single month until you have a vacancy or until you have maintenance. And you're also not going to be spending $130 on a maintenance issue. You might go month after month after month with no maintenance, and then you might have to repair an air conditioning unit and spend $800. So it's a long-term average. What is a leasing fee? A leasing fee is a fee that property managers charge when they procure a new tenant. So when somebody moves out and a new tenant moves in, they usually take about half of the first month's rent out of that income that they receive, and we predict that this will occur on average about every 18 months. So we put these estimates in here. Again, this is what's going in your pocket each month on a regular basis. This is what the long-term average will look like. Sorry for all this mess on the screen here. I don't know how I get rid of that. Now let me explain the management fee. This is 8% of rent minus vacancy. So you're not going to be paying a management fee during a vacancy. Property managers, or at least 99% of them, only charge a management fee while the property is rented. So to get this number, what we've done is we've taken the rent, we've subtracted the vacancy of 130, then we multiply that amount by 8%, and that's how we get this number. So now we're breaking down the expenses and the income, and we're getting a much more accurate idea than I think what most people are used to. So hopefully that helps. And I'm going to show you, yay, got rid of it. Okay. So I'm going to share with you some websites that we can get some data from. So I took this property. The address was 4398 Ridgewood Road, and then I plugged it into Trulia. Now, when we look at this property on Trulia, we can see where the home is located, where that little green house is. And what we're looking at is the local crime. The information, as you can see down here at the very bottom left, comes from spot crime and crime reports. So we see that's fairly good, fairly little crime, except for maybe in this area right here where the red is. Now, we can ask a property manager or an agent, you know, what type of area, why is there, you know, more crime in that location? But we can also get a better idea for looking at what the crimes actually are. So you've got like theft, burglary, so it gives us an idea of maybe what's going on in that particular market. Now remember, again, this was a C-class property. So we have to realize that, you know, I wouldn't go into this with a major fear that something's going to happen or vandalism might happen to our property, especially when there's a lot of green in the location. But it does give us an idea of probably where we don't want to be, and we might not want to be in that red area over there. Now, David, who's one of our real estate advisors, he's with us on the webinar. Before this presentation, we thought it would be a good idea to research our own area. So David researched the Newport Beach, Balboa Peninsula, and we wanted to look at what shows up on this particular property. You know, we saw the crime rates here on Trulia, but then we researched Newport Beach, and this is what we got. And it's fascinating. If you're not familiar with Newport Beach, it's impossible to find a property for sale under $1 million. It's one of the most affluent parts of our country, and it's covered in red. So kind of interesting when you look at your own area what you'd see. Now again, this is disorderly conduct, disturbance, petty theft. So maybe not things to really be that concerned about, but you want to make sure that you're looking at what the actual crimes are. Now, another thing that's helpful with Zillow or Trulia, it'll tell us the median age, percentage of people that are married. It'll give us nearby restaurants. So, you know, we can scroll and move around, get a better feel for the local area. Again, this is Newport Beach, so it's not uncommon that you're going to find something no matter where you are. I want to pop back on our website, marshallreddick.com, and look at the same C-class property. I want to point something out to you. When you're scrolling down, shouldn't be a huge surprise. School district ratings are low. Again, school C-class property. My guess would be that the tenants in this area are probably not very concerned about that because this is a C-class type of property. But you can click on more nearby schools on our website, and you can find out all school district ratings of all the local schools. The data, again, comes from greatschools.org, so you can click on that and find a little more information about the schools. When we scroll down, we can see the market history. Now, this is one of the coolest things on our website. The data that we get is from the National Association of Realtors from 1989 to 2014. So we're getting 25-year history of every single market in the country. Now, we can look at Memphis as a whole, and we can see that at the peak in 2006, the median home price was about $142,000. By the end of 2014, we're at $138,000, but you'll notice that there hasn't been any major year of hyper appreciation or dramatic drop. And as a whole, over the last 25 years, we're looking at about a 2% average appreciation rate. You can find this on any market on our website. When you're looking at a property, it'll give you the breakdown in that market, the year-over-year appreciation or decrease in value. Very, very helpful information. It tells us where the property sits in the Redick property rating scale. So this home, based on the median home price of 138, sits in right around the middle of the C-class category. What we're going to find on a property like this is a high cash-on-cash return. And we would only buy this property if we wanted high cash flow. We wouldn't be buying it if we wanted high appreciation. So hopefully that gives you a better idea of how to use our website, what types of information to get on our website. So now we're going to look at a B-class property. So I picked a B-class property also in Memphis. This property is listed at $143,000. It was sitting right at the border of A and B class, and I'll share with you in a moment why we made that decision to put it in the B class category. But this home's a little newer. It's built in 2000. We're still going to see some really good cash flow on it, but you'll notice at the very bottom right, the annual ROI was quite a bit higher. It was 13% on the C-class property, 19% on this one because it has higher appreciation. So this would be a good combination of both. We're still getting a very high cash-on-cash return. We're also getting higher ROI, so a good combination of both. And we'll start by looking at our website. So we're looking at this property, just went under contract, but I just want to use it as an example. When we scroll down, we can read a little bit more information about the property. We see the school district ratings are a little higher. Same market history because it's just talking about the Memphis market as a whole. And you'll notice that it says this property is actually in the A-class category. The reason that we moved it to B-class is because it's completely rent-ready, completely rehab, doesn't need any work to it, and it would be hard to increase the value of this particular property. So we felt because of that, it was kind of teetering on the border. But you can click this link right here on our website if you haven't already, and then you'll be able to download the Redick Property Rating ebook directly on our website, 40 pages of very detailed content. We can jump to that map that I was sharing with you. Yep, and right there, page 11. So we can click that map, and that will open up the Google Map page that I was describing. So we can click on any market. Looks like I clicked on San Antonio, gives us the median home price, the history, so very, very helpful to use. But we jump back into this B-class property here in Memphis, and I took it and I plugged it into Realtor.com. So Realtor.com estimates this home at 157. What the true value is what the appraisal is going to come back at, and they give us an idea of how they came up with that estimation based on tax records, recent sales prices, recent comps. I prefer to do my own analysis because I find it very unlikely that this is going to be the true value of this particular property. But we can verify the dimensions of the property, but right away it says 3-bed, 3-bath, where this property on our website says 3-bed, 2.5-bath. So we had to actually verify that with the agent in that particular market to find out that it was actually considered a 3-bed, 2.5-bath. I bet you if we looked at this property on Zillow and Trulia, it would probably have different conflicting information on that. But what's really helpful about Realtor.com is it gives us the median home prices in different parts of Memphis, price history of the property, and then the property taxes. So we can see that the property taxes of $1,360 actually came from 2014, and it gives us an idea of how they assess that value. So right now, as of today, 2016, we don't have the information on what the tax value is or the property taxes on this particular property. So if we go back to this property, we scroll down and we go through the expenses, we're looking at this taxes. So now we have to question the agent and make sure that we find out what the tax rate is in that particular county where the property is located, and take that percentage and multiply it by usually 90% of the value of the property, and make sure that we get an accurate representation on the taxes. The insurance you're not going to find online. That's going to vary greatly depending on the deductible and how much coverage that you want in your policy. It's also going to vary depending on the credit of the buyer. So the insurance comes from our insurance agent. So you can make a relationship with Stan Dreckman from Huggins Dreckman and send him different properties, and he'll give you quotes based on your credit, based on how much of a deductible you're willing to pay, and based on how much coverage you want. You can switch these from monthly to annually. And I'll get into this in a little bit, how we determine the ROI and cash-on-cash return. So now let's talk about this property. This is an A-class property in the Cape Coral market, which is southwest Florida, about 2 hours south of Tampa. And what we noticed from this property is it's brand new, built in 2016. The appreciation is much higher. That's because it's in this market of Florida that's seeing much higher percentage of annual appreciation than a market like Memphis. And we noticed that we're getting our monthly income on the right of $430 a month, and then the monthly cash flow of $120 a month. So still not very bad. I think that's still very good income, especially on a brand new property in a market like Florida. So it's an A-class property because what we'll find on NAR and that Google Map page is that the median is right now around $190,000 in Cape Coral. So this property for $208,000, A-class property, and I think quite remarkable to get any cash flow at all. But you'll notice that at the bottom, the 8% maintenance, 8% vacancy, that relates to the A-class property. And let's take a look at Zillow, see what we find on Zillow. Start off on our website. By the way, on our website, you can click on this map here. So you don't even have to jump to Google Maps, and you can throw this little guy on the property, and it'll give you a street view of the property. It's not there yet because it's not built yet. It's a brand new construction property. So the picture we were looking at is actually of a similar, same model home because the property is still a dirt lot, but we can see the interiors of the same model in that development. I believe this is D.R. Horton. Yep, D.R. Horton right here. So when we're looking at this property, in order to determine the ROI, we need to have this information right here. I'm going to share with you first what it looks like on Zillow. So you can see the illustration here. Now Zillow estimates this value at $240,000. Well, I can tell you right now that that's going to be a completely misrepresentation of the current value of that property. I think it's great that there might be a little bit of a chance for this property to grow in the near future, but I really don't put a lot of weight into what they estimate the value at. So when we scroll down on Zillow, we'll find a little bit more information, the parcel number, the floor size, square footage. What I like to look at on Zillow is the details of the history. So we're looking at a 10-year history of this house, the zip code, and then Cape Coral as a whole. So we can see kind of at the bottom of the market, 2009, it says that this home was $242,000. It's because the home didn't exist yet, and $242,000 is the value that they're saying it's worth today. So you notice it doesn't change. But if we look at the zip code average was 155,000. Cape Coral market as a whole, 116,000. And we can go back even further, all the way to 2006, and we can move to today. Very similar data that you'll find on our website. We get our data from NAR, and I think their data is just proprietary information. But we do know that if we're buying this property right now, that the average price in that zip code is $250,000. The average price in Cape Coral altogether, $194,000. So we're buying this brand new home at $208,000. I think that's a very good sign. Tells us the type of heating. This property is still under construction. So some really helpful information about the property. But again, if I'm looking at other properties in the local area, you have to keep in mind a couple different things. So I'm a licensed realtor in California, by the way. Our company is a licensed brokerage. We all list and sell property in our local market here in Orange County. We use the MLS. What we find is many times that what's in the MLS might not even appear on Zillow, and what appears on Zillow might no longer be relevant or current on the MLS. And here's why that is, because certain local board of realtors offices in different parts of the country have a relationship with Zillow where whenever they list property on the MLS, it appears on Zillow, and certain board of realtors don't. So sometimes an agent has to actually manually go into Zillow and Trulia and upload a property if they want it to appear on here. It's very likely that you'll find a property on Zillow that doesn't say it's for sale when in fact it actually is, and the agent didn't know or Trulia and uploading it for sale. So if you're only using Zillow or Trulia, then you're missing out on a lot of other properties that might be listed for sale, but you might not be able to see it. And I can't tell you how many times I've seen a property that says for sale when it's actually pending on the MLS, or it might say pending on Zillow when in fact it's actually closed. So a lot of listing agents don't really use Zillow or Trulia very well. So it's a good starting point. It's a good place to start, but I wouldn't put all of my analysis on Zillow and Trulia. You have to have a local agent who can verify the information that you're looking at. You also have to have a local agent who can walk through the property and tell you the condition of the property, because I've oftentimes seen a description that was incredibly misleading. I remember reading a property's description one time on the MLS that it had a newer roof, and when we finally looked at the property, we found out that the roof was, I think, about 10 years old. So what is their definition of new? I mean, it's not the same definition that I have. So very good to have a local agent that can verify all this information for you. So we looked at this Florida property on Zillow. We got a better idea for the zip code average, the entire market average, and now what we want to do is figure out how to calculate the returns. So if you're looking at growing your wealth, building your wealth, and having appreciation over time, the calculation that matters most to you is getting the highest annual return on investment as possible. If cash flow is more important to you and you don't really care about building your wealth or care about the appreciation of property, then getting the highest cash-on-cash return is going to be the most important calculation for you. So let's talk about the return on investment. So you calculate return on investment by taking the profit from selling the property, dividing that by the amount of money you spent when you purchased the property, then you divide that number by the total number of years that you held the property. Sounds like a pretty simple calculation. However, figuring out the profit from the time you purchased the property from the time you sold the property is not exactly easy to do unless you have the right tools to do it. So we're going to take this property in Florida, listed for $208. We're going to do a 15-year example of what it would look like. So we see down here at the bottom that our 15-year ROI is 22.7% on average. Okay. So now we got to look at having the right financial calculator. If we don't have a financial calculator, it's absolutely impossible to figure out and analyze a property. So we see that this little hammer here has a red box around it. The reason is because this is a brand new property. So in the Redick rating ebook, you'll read that for the first 6 years of a property's life, we use a reduced maintenance rate because we're obviously going to have less maintenance on a brand new property. So because this property is brand new, we use a reduced maintenance rate of 5% because it's A-class. We take 5% of the monthly rent for maintenance for the first 6 years, and then years 7 through 15, we go back to that 8% maintenance. And if we add the cash flow up, it's about $25,000 over a 15-year period. Based on that appreciation rate of 3.7% that we get from NAR, we use a simple appreciation approach, multiply that rate by that $208,000 purchase price. We take that annual number, we multiply it by 15, and we're left with about $151,000 of expected appreciation on this property over 15 years. Principal paydown, we have a mortgage calculator built into our calculator, and over 15 years, the principal balance reduces $54,000. Now let me go to our website and show you exactly where I'm looking at this information. So this is the property in Florida. When we look at the property on our website, we're going to scroll down to the financial calculator. And again, remember, it's that $120 a month. But what you'll notice is if you change this number to year 1, we're getting $170 a month. Year 2, 170. Year 3, 170. Year 4, year 5, year 6. Finally, year 7, we have a reduced cash flow. Now that's our estimate because we're using that lower percentage of maintenance. Now let's look at this on a 15-year example. Same exact numbers we were looking at. I just screen captured it on the slide we were looking at. But we can see how the numbers change depending on how many years we hold this property. And of course, the longer we hold it, the higher return we're going to get. So if we go back to 15, we get down to selling expenses. We put our cursor over and it says 3% for the listing agent, 3% for the buyer's agent, and 3% for closing costs. So what that means is if you're going to sell a property, you're going to have some expenses, right? You're going to have to pay about 6% in realtor fees, and then about another 3% in fixing the property up, and maybe even paying some of the buyer's closing costs. So if we take 9% of the future value of this property, that's $32,000. So after adding up the cash flow, appreciation, and then the equity that we built from the principal reduction, then we subtract the selling expenses, we're left with about $199,000 of profit on this property over a 15-year period. So then we take that number, we divide it by $58,000, which was the example I used at 25% down. If you have less than 4 mortgages, you can do 20% down. I always like putting an extra 5% because that gives me a better interest rate and more cash flow. Then we divide that by 15 because that's the example we're using. We're left with an annual return on investment of 22.75%. So let's look at that property again. You'll see investment capital needed, $58,501. That's the summation of the down payment, any initial repair costs, and then any closing costs. We're going to have title and escrow fees, a home inspection, appraisal costs, processing and underwriting fees. So we estimate that at 3% of the loan amount. We're left with $58,000 of total cash invested. So annual 22.7%, not bad at all. Can't find anything else that has that rate of a return while having a tangible investment and still receiving tax benefits on top of that in most cases. So cash on cash return, a little bit simpler. It's the annual net cash flow divided by that same number, the total cash invested. So we're going to take that C-class property because that's what has the highest cash flow. Now what we're going to use is the long-term average. So we're going to use that $133. We're going to use that $133 long-term average. And we're going to look at the annual net cash flow. So we take 133, multiply it by 12, divide it by the total cash invested, which is $25,000. So in order to get that number, we have to keep in mind a few things. If we use $421 a month, we're going to have a probably very misleading cash on cash return because of course there's going to be times we have vacancy, of course we're going to have maintenance, but if we take the long-term average, now we have a much better understanding. You have to keep in mind a couple different things here. There's going to be years where you might have a 10 or 12% cash on cash return because you might not have had any maintenance and vacancy. There might be years where you have a 3% cash on cash return because you had vacancy and maintenance. Again, this is a 10 or 15-year average. So if you haven't read the Redick Property Rating ebook, you can go on our website and download it for free, marshallreddick.com, click on the Invest tab at the very top, and then click on that button on the right, that gray box. It opens up this extremely detailed and informative ebook full of information, no hype, 100% education. It's probably going to be the most comprehensive and the most informative 38-page book you could possibly read on real estate investing. I want to show you one more thing before we wrap up. So when it comes to getting market data, we've actually spent countless hours compiling information on each market that we have, and I'll share with you right here. When you're on marshallreddick.com and you click on the Learn tab, now what you can do if you want to get that market data is you click on Guides on the left, and then you click on Market Data. And you're going to see a detailed economic packet on every single market: Dallas, Memphis, Austin, Cape Coral, Toledo, San Antonio, Houston. So this is kind of what it looks like really quick. When you can click on it, you can either look at it in our viewer or you can download it. But what we're going to see is usually about 20 pages of information on each market. We're going to see attractions, culture, recreation. By the way, everything in here is linked, so you can click on these links. It'll take you to the website that we got the information from. We see the industry diversity, so the percentage of jobs in about 30 different categories. You can see that information we got from the Bureau of Labor Statistics. Economic and business climate, so who are the major employers? What's the job growth looking like? You can see Liberty Mutual and Toyota, all FedEx. So we're looking at data that we compiled from the Economic Development Guide. Scroll down a little bit further, we're getting employment data now. We can see the percentage of unemployment over the last 20 years. Again, came from the Bureau of Labor Statistics. So you don't really have to reinvent the wheel. You can download this economic guide in every single market that we're in. Data on demographics, home affordability, cost of living. We can look at the population growth from the U.S. Census Bureau. So I hope you don't feel like you have to completely reinvent the wheel. You can get this economic guide in every single market that we have. I think it's a great place to start. Percentage of homeowners versus renters. Extremely detailed. It's concise. It's not 100 pages. It's about 20 pages of very concise info. That would be found on the Learn page of our website, where you can also see a ton of videos. In fact, the one we're doing right now is being recorded. You'll be able to probably actually, you're viewing this on our website, actually. Now let me point out one more very important thing. So if you haven't spoken to a real estate advisor yet, then I would highly, highly recommend giving yourself the opportunity, taking advantage of a consultation with an advisor. David Kling is with us. He's actually already answering a lot of your questions right now, I can see, and scheduling consultations. David Kling's been with us for several years. He does usually about 15 to 20 consultations every day with brand new people who aren't even ready to buy yet, all the way to seasoned investors who are on their 8th, 9th, and 10th property. And on that call, you can ask him as many questions or as little questions as you want. You can spend as much time or as little time as you want on that call. And we're here really to just guide you in the right direction, help you set your goals, figure out your investment criteria, learn more about the markets that make sense for you, evaluate potential investments, go over them and figure out which ones fit your criteria the best, and then walk you through the process from start to finish. If you haven't spoken to an advisor yet, then you're missing out. You're missing out on that opportunity to work with an expert who can point you in the right direction. And then finally, here's David's information. You can see David's a very nice guy. He's got experience working with hundreds and hundreds of clients. He's a licensed realtor himself, helps people buy and sell property in Orange County and LA, and then also works with our affiliate brokers in each out-of-state market we're in. I want to thank everybody for being on this webinar and this presentation. We really look forward to talking to you in more detail. I tried to go through as much information as I could in an hour. If we left anything out, please give us a call, ask us questions, and we really want to help you become as educated and as informed as possible because we're here for your success. So thank you very much for being on the webinar. Really appreciate it, and happy investing.